Good morning, all. For those of you who are subscribers, welcome back to the channel. For those of you who aren't, please do consider subscribing and hitting that bell notification button so that you'll be alerted whenever I upload videos. And of course, also if you find value in the content that's being produced, please hit the like button and also leave a comment. And particularly comment on any topics related to personal and our business credit that you're interested in, because that's what this channel is devoted to. Really, all things credit, personal and business, and in particular, providing a credit education that none of us received in school, but frankly should have, because credit obviously has very significant impacts our lives, very significantly in many ways. So with that said, I want to talk today about a topic that I do think there is some confusion around, and that's the issue of cosigners or cosigning on an account. I had a client who contacted me recently and called me and says, "Hey, Earl, I've got this account on my credit that I need you to get off because it shouldn't be there." And of course, my response was, "Well, why do you think it shouldn't be there?" And his response was, "Well, because I just co-signed on this account. It's really not mine. It's my son's. He went out and he wanted to buy a car, and he couldn't get qualified on his own. So I co-signed, but it's his car. I don't drive it. He's primarily on the account, and I just co-signed for it." And of course, he missed some payments. There are some late payments that were being reported. Ultimately, he stopped paying. The car got repossessed, and now not only does the son, of course, have a repossession on his account, on his credit reports, but now the father does because he co-signed. And his response, and again, and his belief was, "Well, hey, I this shouldn't be on my credit report because this isn't my car." Well, my response was, "Yeah, it may not be your car, but you know what? You are every bit as responsible for that account as your son." Okay, there is a concept in the law called joint and several liability, and what that means simply is that co-makers on a debt obligation. So a debt obligation, a mortgage, an auto loan, a credit card, a installment loan, whatever the obligation is. Co-makers on an installment obligation, on a credit obligation, are equally liable. So the concept of joint and several liability means simply that they are jointly liable, meaning that all of the makers are liable, but several means each one can be held liable in his or her individual capacity. Okay, so when you co-sign on an obligation, the creditor, whomever issued the creditor, can come after you individually for repayment of that obligation, okay, without even going after the person who's primary on the account, the person for whom you co-signed for, okay. And I learned that lesson. It was almost the hard way. Fortunately, it didn't become as bad as it could have been. But I'll tell you a little story about that. A number of years ago, well, many years ago now, 40 years ago, when I got out of law school, 1982, my first secretary, super nice lady, just super nice lady, but her life was an absolute 100% train wreck. Single mother, many kids, family members in and out of jail, lights being, electricity being turned on and off, and she had a drinking problem. It went on and on and on. When she was at work, she was fantastic. Just absolutely fantastic. But from the time she left work, her life was just a train wreck. Okay. So she came to me one day and said, "Hey, went to the bank. I desperately need a loan for this, that, or the other. And of course, my credit shot, but the banker, who was my banker, because I told her to go see this guy, and even though I'm just a young lawyer, I was in a very prestigious law firm, and actually one of our law partners owned this, or his family owned this bank, so we all banked with this particular institution, and so from the moment we joined the firm, we were hooked up with with the personal banker, and so I said, hey, go see this guy. And of course she did, and of course he ran her credit, and of course he was like, yeah, sorry, Nancy, we can't, this isn't gonna work, sorry. And but he did say, hey, look, if you could get Earl a cosign for you, then we can make this happen. So she came back to me and she says, hey, Earl, would you be willing to co-sign on this loan? Because they said that we can get it done if you co-sign. So of course, I'm like, sure, happy to help you. And so I co-signed. They gave her the loan, and then for the next year, everything's fine. Payments are being made. I don't hear anything about it. Don't really care about it, honestly. As she's making a payment. So hey, peachy keen. Life's great. And then about a year into it, she told me that she was not only leaving the firm, but she was leaving the state. She had a daughter who lived in Houston, and her daughter was having a baby, and she just was going to go relocate over there to help her daughter. Okay, so fine, not a problem. About 2 months after she left, I got a call from a banker, and he said, hey, Earl, just want to let you know Nancy missed her payment. And, she was either 30 or 60 days late at that time. And, of course, my response was, okay, sure, hey, thanks for letting me know. Talk to you later, not really registering where this is going, okay? And so 30 days later, he calls me and he says, hey, Earl, Nancy now is 90 days behind, and we want to know how you want to handle this. And I'm like, what are you talking about, handle this? And he's like, well, we need to get paid. Okay, we don't care. We get paid from Nancy. We get paid from you. But somebody's going to pay us, okay? And if she doesn't, then we're going to look to you for the money. And I'm like, okay, yeah, you would think being a lawyer I would have understood that going in, but I didn't fully understand the ramifications of co-signing on this account. So of course I said, hey, I tell you what, let me get hold of Nancy and figure out what's going on, and we'll get this figured out. I wasn't particularly as a young lawyer, and I think my starting salary in like 1982 was like $30,000 a year, and this was like a $15,000 loan. So I'm like, yeah, they would have basically just, and I actually had credit with the bank. I think I had like a $15,000 signature line of credit with them. So they're like, hey, we can just flip this over to your line of credit. You can just start paying us. And I'm like, okay, well, I'm not really interested in doing that right at the moment, but let me see if I can get this worked out with Nancy. So I called Nancy, got hold of her, and says, hey, look, hey, talk to me, what's going on, blah blah blah. And she says, yeah, I apologize, I kind of ran into some issues and I needed to take care of, but she says, I promise you, I'm going to pay it. I'm going to get back on track. And to her credit, she did. She wound up getting back on track, and she wound up paying it, and she, wound up paying it till, and until she, she paid it off, thank God. But the point of the story is that had she not paid it, guess who was going to have to pay it? Me. So when you go in and you co-sign for a loan, understand that you are, irrespective of the person who you're co-signing for, you are 100% responsible for that loan. You can just whatever remedies that the creditor has against the person who's primary on the account, they have against you as the co-signer, that account will report to your credit report just like it reports to the to the person who's primary. So if that person misses a payment, defaults, or in the case of a revolving account runs up the balance, it's going to affect your credit every bit as much as it's going to affect the person who's primary. And there is another very important piece of this that I don't think a lot of people really take into consideration, and it's the issue of debt to income ratio. Okay, let's say you've got great credit, and you decide to co-sign on a loan for somebody, a family member, a friend, whatever. And let's say that person wants to go out and buy something really expensive. So, $70,000 Tesla or something. Something that's really expensive. And with your co-signing, they can get approved. Well, that's all great, but now that account's going to report to your credit. To not only is it going to be on your credit reports, but that debt is going to be on your credit reports, and now all of a sudden it's going to change your debt to income ratio. Okay, and is that the end of the world? It's not, except for if you yourself or feel like you're going to be in the market, say, to buy a home within, the relative near future, the next year or 2 years or whatever. Now all of a sudden that your debt to income ratio becomes a really big deal. And let's say, for example, you were in a place where prior to adding that account, your debt to income ratio was, say, 40%. And debt to income ratio just simply means that a potential creditor looks at the monthly debt obligations that you have and divide that by your gross monthly income. So, for example, somebody let's say a mortgage broker pulls your credit report, and there are, and they look at all of the debts, your car debt, your mortgage debt, your credit card debt, your installment debt, blah, 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 all those kinds of debts. And let's say it totals $4,000 in monthly debt service obligations. So on the course of a month, you're paying out $4,000 for all of those debts on that report, and your income stays $10,000 a month. Okay, now all of a sudden, so not all of a sudden, but now your debt to income ratio is 40%. 4,000 divided by 10,000 is 40%. But let's say now you go out and you agree to co-sign on an account for $70,000 Tesla, just picking that as an example. And let's say that monthly payment's $1,000. Well, are you making that payment? Well, hopefully in a perfect world, you're not. Hopefully it's the person who you co-signed for. Heaven forbid you wind up having to make it, which you could which you could be forced to if they don't. But let's say that's not the case. Let's say they pay it, but it's still on your credit report. It's just like it's on the credit report of the person who did the original loan. It's going to be, who's primary on the loan. It's going to be on your credit report also. And now all of a sudden, you've got, say, now another $1,000 debt obligation on your credit report. And now all of a sudden, your income, your debt service has gone from 40% to 50%. Well, at 40%, and let's say you want to go and buy, a home. Well, at 40%, you're okay. Your debt to income is not going to, at 40%, prevent that in and of itself. Obviously there are other factors to getting qualified to buy a home, but just carving out that piece, your debt to income ratio in and of itself is not going to prevent you from being able to buy, but let it go to 50%. Yeah, you haven't lived until you've tried to get qualified to buy a home with the 50% DTI. I'm not saying it's impossible, but I'm saying it's a way more difficult than at 40%. So let's look at it. You co-sign, you are 100% responsible for that debt. It's going to go on your credit report, good or bad. And if it's bad, it could be really bad if the person defaults, or if it's repossessed or foreclosed or whatever. And it's going to affect your debt debt to income ratio. You know, when people ask me about co-signing on loans, or any kind of credit obligation, my response is there are a lot of things that can happen, and most of them are bad. Okay, so usually my response is don't do it. I am not a fan of co-signing on accounts, as you can tell. I mean, you know, if I had to for my, you know, for my wife or my daughter, you know, I would, but short of that, I just wouldn't do it. I mean, it's just, there are just a lot of things that can happen, and like I said, most of them are bad, and so I'm just not a fan of it. But you know, but obviously we're all big people here. Everybody makes their own decisions, so you know, you decide what's best for you, and there are going to be instances where you need to do it. You know, can't be avoided, and if you have to, you have to. But short of that, I am I advise against it, frankly. Okay. All right. Hey, appreciate you listening. If you have any questions, you can email me. My email link will be down below, earl@restoreyourcreditllc.com. If you have, or if you want to drop a question down in the comment section, I'll be happy to respond. And again, if you have any issues or topics that you'd like for me to address in these videos, please drop it down below in the comment section. Hey, thanks for hanging out with us today. I do appreciate it, and we'll see you on the next video. Take care. Have a good day. Bye.